Hi, everybody. It's Barry McGuire here for Barry McGuire's Creative Real Estate Education Series. It's the Monday main event. Every Monday at 5 p.m. Mountain, we get together and talk about all things related to creative real estate. We like to have experts on tax, insurance, mortgages, and that's what we have today. We have investors on. We do the investor spotlight where we talk about real deals. We like to have people come on, talk about a deal, and come back later and tell us about another deal. I've got a few in mind for people we've had on a few months ago where their transactions have progressed, and I want to get some of them on to talk about that a little bit more. We also do focus workshops. Had a great focus workshop on May 7th and 8th in Calgary. The Rapid Cash program, that's our hallmark, our flagship program where we discuss 6 different strategies related to creative real estate. We had, I think, 40 students there about, and it was wonderful to be doing things live again after 3 miserable COVID years of not doing live events. Doing them virtually is okay. We did do some, but live was great, and I sure appreciated everybody who showed up. It was really good, and we're planning to do more. We've got an AFS only focus workshop, in the planning stages for September. So we'll hear more about that later. But today, enough of that. Today we've got a couple of mortgage experts on. Neil Oliver from Clover Properties. Neil is a mortgage agent / broker. He and his wife Rachel run probably the most successful rent-to-own business in Canada. They've been doing it for a long time. And of course, mortgages and interest rates are vital to that business. And we also have Sean Impey, who's located in Alberta. Sean helps a lot of different people with their mortgages, both, the regular and the creative side of things. So let's get Sean and Neil in here. And I always have to remember that some folks are watching this for the first time, and where lots of folks are very familiar with Neil and with Sean and what their background is, other people aren't. And so, Neil, let's start with you to give us a bit of background where you and Rachel were at before starting your rent-to-own business, these many years ago. You guys were in the corporate world. So give us a bit on that, roughly how you got into rent-to-own, got to be a mortgage broker, and where you are today. And that'll give people some perspective, and then Sean can do the same. So Neil, tell us about you and Rachel.
Yeah, thanks, Barry. Thanks for having me. It is a little bit weird not having Rachel on here with me. Normally, she's like my second head on here and controls what I say. This is going to be interesting. But we, 12 years ago, we started rent-to-own, and we did it more from the perspective of, just our own personal investment. That's really what it started out as. And as people started to hear about what we were doing, they wanted to know how they could invest as well, because it was, for us, it was all about helping a family get into home ownership and, alternatively helping them get ahead, right? And that's why we started this. We had some things happen in our own lives, something with Rachel's medical history that kind of put us in a situation where we wanted to give back. Prior to that, we were both in marketing. I was in the online marketing world, ad agency world, and Rachel was in marketing for an engineering firm. And she decided that we weren't going to get ahead living paycheck to paycheck. Even if those paychecks were nice, they weren't helping us get ahead. So how did we get into rent-to-own? Well, Rachel made us get into rent-to-own. That's the reality of it all. I did not want anything to do with real estate at the time. I regretfully look back at that and think what an idiot I was, because, had we jumped on board earlier, we'd probably be that much further ahead than we are now. But certainly we've been doing rent-to-owns now for 12 years, and we've helped over 650 families. And, it's been an extremely amazing adventure. And, we've seen all the ups and downs, all the interest rate increases and drops, and the market changes. And what I can tell you honestly, and we're going to probably discuss it later, is that, no matter what happens in the market, rent-to-own can still be a really great investment vehicle.
Okay. Well, that's good background. And I think it yet again, it illustrates how our values are aligned because, you and Rachel have wanted to and have found that through your rent to own program, you can help people. And I know Sean looks at it like that, and our whole focus team and our focus workshops are aimed at helping people and turning everything into a win-win problem solving situation. And it's just amazing. I mean, you just don't hear about it in the business that we're in. It's the old story. You hear everybody say it. You can get anything you want by helping people get what they want.
Bingo.
So yeah, we're all aligned on that front. Now, Sean, you've come to be an investor and a broker and involved in creative real estate a little bit differently than Neil and Rachel. So let's have the busman summary of who Sean is and how he got where he is today.
Well, I got my start in real estate about 22 years ago. I went for a coffee with a fellow named Arlen Dolan, who a lot of people know, and with a buddy of mine, and I tagged along, and buddy wasn't interested, but I sat and had a chat with Arlen for probably 2 hours. And at that time he had 150 doors working a full-time day job. So I thought, well, sounds like a good guy to get tied up with. So I was working construction, making lots of money in Fort McMurray. So I had cash to invest. So I was a cash partner with Arlen we bought 5 properties in 6 months, all assumed mortgages. When you could do that, you just sign a piece of paper and take over somebody's mortgage. All you needed was cash down. So we bought 5 properties for $135,000 total, and still got 3 of those today, and Arlen and I are still partners. So made money on the ones we sold. So I worked my construction job until I got tired of that and retired and didn't know what to do. So I had real estate, had lots of doors at the time, and said, well, maybe I should be a realtor or a mortgage broker. And realtors work too hard and pay too much money every month and can't go on holidays. So I said, mortgage broker. So took the course and learned the ins and outs at the start, and soon discovered that the course is only about 1% of what you really need to know to be a mortgage broker. So you've got to have experience and deal with everyday situations, and very few files are cookie cutter, nice and easy. The mom and dad buying the family home with good income and no debts and no other properties and stuff like that. Those are the one that every broker likes to see. So I've turned my focus to investors and being an investor myself. I got lots of doors, got multifamily, condos, apartments, and kind of seen everything. And I always tell my clients that if you haven't made a mistake in real estate, you don't own a property. And second thing I tell them is I probably made all those mistakes myself over the course of years, or seen people make them. So I can share them with everybody so they don't get in the same rut. So the reason I focus on investors is, because I'm an investor myself, plus I'd sooner have clients buying a property or 2 every year or every second year than doing the one and done, and you don't see those clients for 5 years if they're buying their own or occupied home generally. So,
for sure. So
it's a better way to keep things churning, and it's a different approach. I get my clients from a lot of investor meetings, Barry's group or Edmonton Real Estate Investors or Fearless Investors and stuff like that. So not relying on realtors to refer me to deals, although I do work with some. So, and I generally have seen people's situations before. So when they ask me questions about, investing in real estate, I can give an opinion. Of course, it's not a legal opinion. It's not an accounting opinion or anything like that, but it's based on my
experience,
school of hard knocks and experience. And we can talk about what the best thing to do is. And I also tell clients that, rate is something we look at after we figure out what the right mortgage is for you. And get you a rate that fits into the mortgage that works best, and
It's into the plan.
not always those low ball rates you see advertised on the internet that are high ratio insured mortgages, sometimes with clauses and conditions in them that you may like it today when you get that cheap rate, but you may not like it a couple of years from now when you got to sell your property or move, and they're going to charge you a penalty or find out you can't even get out of your mortgage. So
let's get into, you mentioned rates a few times, and that's really what we want to talk about today. So let's talk about rising rates. Everybody who's watching today, I'm pretty sure will be aware that we're facing inflation here in Canada. We're facing inflation in the US. Not sure whether it's the same thing worldwide, but I kind of think so. Central banks are, after years of rock bottom interest rates, deciding that to slay the inflation tiger, they need to raise rates, which suppresses demand. And if you raise rates for long enough, high enough, inflation will die. I believe that's the theory. We've had 2 half-point raises in the Bank of Canada rate, which puts the rates that people actually have to pay up at least a percentage point higher than they were. So let's get back to Neil, and let's talk about how the rising rates have affected your rent-to-own business. And Neil, get your general thoughts on what rising rates are going to do to creative real estate.
So it's a great question, Barry. And I think from the rent-to-own perspective anyway, we really haven't seen anything. It's impacted us in a way that the payments are bigger for the tenant buyers. Let's put it that way. But we're now qualifying them based on a higher rate. They have to still be able to afford the payments at the higher rate. This is really no different than if they were qualifying for their own mortgage, right? They would still have to pay a higher rate and their monthly payments would be higher. The difference, of course, with the rent-to-own is that you've got the option credit. So you have that little bit of money each month that they pay you to hold for them to add to their down payment. So their payments are a little bit higher than what they were 3 months ago, 4 months ago, of course. But we're just qualifying them differently. Our investors are still, for the most part, taking variables. Variable mortgage rates are still much lower, in my opinion, than a fixed rate. We always add in a little bit of buffer. So there is some room that if the rates were to go up another 0.5%, the investors are still fine. They're still making money on their deals. And any deal going forward now, we're using, like I said, a 4.5% rate in order to determine what that monthly payment would look like. So anything an investor can do better than 4.5% would just put more money back in their pocket.
Okay. I think that goes to the notion that if you've been around real estate long enough, and all of us have been around it quite a while, that people buy houses in good times and bad times. So maybe low interest rates promote asset inflation, and so maybe interest rates are lower, but house prices are higher. Now we have interest rates are higher, and house prices maybe start to lower down a little bit. But people buy and sell in good times and bad. People want to be homeowners in good times and bad. So Neil, when you're talking about qualifying people differently, you qualify them at a higher rate, which means their interest payments would be a little bit higher. Does that also mean that maybe they have to move down the pricing scale a little bit and say, we can only afford an $800,000 house instead of a $900,000 house? Does that work into the equation as well?
Yeah, for sure. I mean, we're still looking at qualifying them based on the stress test, right? That's still critical here because, again, they need to be able to qualify today as well as 3, 4 years from now, whatever the situation might look like for them. So that is definitely one thing, right? But on the flip side, I think what's really interesting is that it's here in Ontario anyway. Ontario, we're starting to see rents increase. We have been seeing it for quite some time. We're still seeing it. Like I'm looking at some places that are renting 1-bedroom apartments, renting for $2,500, $2,600, $2,700, right? So to rent a full house, you're probably looking at, in some cases, $3,000, $3,500, depending on what that house was purchased for by the investor that wants to rent it. So we are still seeing people buying these single family homes at 800,000, 900,000, which, again, is ridiculous here in Ontario, but that's where we're at. And to your point, I think what's really interesting is that the lower interest rates created a bigger market with more competition, which bumped the prices up. I would prefer, honestly, to purchase in this market all day long. We have been able to close on deals, 4 deals in the last week and a half, simply because there's just not as much competition as there was 3 or 4 months ago. So it's changed dramatically in terms of making offers and getting offers accepted. We've changed how we qualify them. So certainly we're qualifying them at a higher rate. They still have to be able to afford it. That's like one of my key tips, is that it doesn't matter what I tell you can afford. You still have to fit it into your monthly budget and comfortably, right? So we still have to put some onus back on them. But again, we want to direct them in the right direction. So this is your budget. Here's where we want you to be. And whether or not they're able to find something, well, that becomes the biggest question now, right? It's just interesting because 500,000, which is 5 years ago, 3 years ago, was a pretty high or expensive property, is now entry level here in Ontario.
Yeah.
And it's hard to find. Even then, when you're looking in areas within an hour of Toronto, 650, 700 is entry level. So we don't put them into a different price point per se, because if they still can't afford it under the stress test, then we just can't work with them.
No.
And that's sad. It's sad when you can't help a family get to where they want to be, but that's kind of the cost of what's happening in our market. The price is going up, the interest rates increasing. Like it's limiting a lot of people from being able to qualify for their own mortgage, but it's also limiting them from getting into a house through rent own.
Yeah. All right. Well, moving over to Sean. I mean, from Neil's perspective, it's cooled the market a little bit, and he's able to write, I think he said 4 deals in this last little while, whereas 4 or 5 or 6 months ago couldn't have written those deals because you bid on the property and there's 7 or 8 or 10 other people all bidding higher than you, so you can't get a bid. So there is an upside of this current high interest rate environment. Now that's in Ontario. Sean, what about you on your end? I mean, the market is different in Alberta. We've had our own little blip here over the last while of rising sales and I think rising prices in certain markets. Can you point to any upside of the rising rate environment for folks investing out here in the West?
Well, the market has slowed a little bit with the rise in rates. Certainly there was lots of comments I heard from fellow bookers in my franchise there that they had people qualified and they would made 3, 4, 5, 6, 8 offers and never got one through the door because people were making unconditional offers or bidding well over lists for properties that might not have appraised or things like that. So that's a little more reality there. Just wanted to comment on rising rates. There's 2 types of rates out there. One is the fixed rate and one is the variable or adjustable rate. So the fixed rate works off the bond, the Canada bond rate. So
yeah,
as it goes up, the fixed rates go up. So it's potential that fixed rates can rise and variable rates don't, or vice versa. So when Bank of Canada raises the rate 0.5%, the variable ends up getting closer to fixed. When the Bank of Canada stays stable, like it did for the year and a half or so in 2 years in COVID, and the fixed rate can go closer, further away from the rate. So I get a lot of people comment to me here after the rate went up on June 1st. They said, "Oh, geez, all the interest rates have gone up." I said, "Well, only the variable." So I mean, if you're still looking at fixed, those rates didn't go up. So try to educate people. And I agree with Neil. Variable is still at quite a bit of discount. It's about 1.5 less, depending on what lender you look at. You can get some fairly good discounts to prime, which is 3.7. So you still get mortgages for under 3% on the variable side, and then you're paying anywhere from 4.5 to 5 from the big banks for fixed rates. I saw, quite a few of them are at 4.89, 4.99. So still a big jump. So if you're looking at it today, what's better? My opinion is variable is the way to go, more flexibility. And if we do run into a little bit of a blip or recession or something like that, and rates start to go backwards, then your variable rate will go backwards too, but your fixed won't. If you locked in at 5% today, you're at 5% for 5 years. So you don't have an opportunity to take advantage of any drops in rates in the future if it's going to come to that. So another thing to look at when you think about rising rates, what's my payment going to be? And fixed rate, next 5 years, I'm paying $2,000 a month, and it's not going to change. If you go on the other side where you do something that changes with a Bank of Canada rate, you need to know that there's two types of mortgages out there. One is called adjustable, which is offered mainly by the monoline banks and one or two of the big banks. That means your payment changes every time the Bank of Canada changes their rate. So Bank of Canada rate goes up 0.5 point, your payment increases. So if it went up 0.5 point, it'd be about $25 per 100,000. So anybody who had say a $400,000 mortgage and their payment was $2,000 on May 31st, on June 1st, when the rates went up 0.5%, they're paying about $100 a month more for their mortgage. So hopefully if they're in that type of property, that's not going to break them or anything like that, but that's kind of the impact. So you can also get a true variable rate mortgage where you can have fixed payments, but your interest rate still changes. So you just pay more towards the interest than you do towards principal when the rate changes. So that's a good product for someone who wants to be in a product that's got a cheaper rate. They don't want the payments to change. So the caveat is, of course, that if interest rates go through the roof, which I don't expect to happen, there's a ceiling where your payment does have to change because you're not paying enough to cover the interest. So, and Neil also hit on a real good point about qualification versus affordability, and there's a big difference. And my analogy would be you got a single guy with a car payment, no wife, no kids, and he makes $100,000. He can qualify for X amount, and you got a husband and wife with a couple of boys, couple of girls. They make $100,000 and they have the same car payment, but guess what? They got hockey and dance and all the other things that go on. So they both qualify for the same amount of money, but one can afford it and the other one's probably can't. So
Yeah.
really, really important to understand your budget and what you can afford versus what you can qualify for.
When you guys are analyzing this, I mean, as mortgage brokers and mortgage agents, and you hear your fellow brokers chat about things, you look, there's stats. You're not ever going to say to your clients, okay, variable is the way to go, and I'm guaranteeing that variable is the way to go. And I mean, none of you guys are never going to say that because you couldn't say that. But Neil, over to you when clients say to you, Neil, what should we do? Do you point to long-term stats that support that over time variable has been the way to go? How do you talk to your clients about that? Or do you just go, I don't know, your guess is as good as mine. I like variable. It's your choice. How do you talk to them about that?
Well, I think definitely long term. If you look historically at what things have been doing, variable has always been a little bit a better performer for sure. Always a little bit less. Even now, we're seeing a little bit less. The threat has always been that variable is going to catch up to fixed, and you better lock in now. But that's also the bank's ploy and the bank's way of getting people to lock in. And I think Sean made a great point that and I do believe we're going to see interest rates come back down a little bit, maybe in a year or so. It could be 2 years, but I don't see it going too crazy either. But if you do lock in, you do miss out on the opportunity that when the rates do come down, you're going to be back in a good spot, right? And let's be realistic. I think what's really important here is that money is still cheap. If it's 5%, it's still cheap. We were spoiled at 2%, 1.5%, whatever the situation might be for whoever it might be for. We were very spoiled. And I think a lot of people are freaking out a little bit because, they may have made purchases that at a lower interest rate made sense, right? Like I'm thinking multifamily, for example, where you might have got a great rate and it's variable and it might be adjustable. So it's going up now and you might not be able to cash flow as much because we are seeing them going off rent to own for a little bit, but we are seeing a lot of people starting to sell multifamily. And I think there's a little bit of a panic around the fact that, maybe their mortgages weren't as great as they thought they were if interest rates were to increase. They weren't. See, and that's part of it, right? It's not only about your personal budget, it's also about accounting for these types of things. So I'm ultra conservative, maybe to a fault, but I know that, 12 years of doing rent to owns, I haven't had one single failure as a result of my numbers. I don't put people into homes at the top of their budget. I make sure that their down payments are going to work out at the end of the term as well. That's how we purchase our own properties. We make sure that we're testing our own numbers against higher rates. In fact, we're probably even qualifying ourselves at higher rates just to make sure that those mortgages are going to fit, right? Because we don't know what's going to happen. But historically, you can have a look back and you can actually see that variable has performed better than fixed all the way through for probably, I'm going to go back 6-7 years at least, probably can go way back further than that. But my best advice would be that when you're running your numbers, run them at a higher interest rate. Make sure that at 7%, you're good to go. Right? Make sure it makes sense at that point, because like we see here now, we just don't know when that next rate increase is coming. I think we do know. I think it's going to be in July is what they're threatening. But as long as you've kind of tested your mortgage out against those higher rates, you should be fine.
Yeah. Well, when you talk about interest rates going up and 5%, that's a rate that we can see around. I bought my first house. It was a 12% 5-year term. And 12% was the rate. Nobody batted their eyes at it. It had been that way for years, and it was the standard 5-year rate. So, people buy and sell whether the rates are up or down. I mean, they buy more and they can afford more, of course, when rates are lower. But people do buy and sell in any market. And so I think one of the silver linings that we might have is, I just relate that to what Neil said about being able to compete on and get unconditional offers where you were missing out on them 4 or 5 or 6 months ago. There is less competition. So for creative investors who are out there looking to do deals, you may find that there are actually more deals to look at in rising rates because some people just abandon the market and they just go, oh, well, rates are up. I can't. Why should I? So that is, I think, rising rates, you have to look at them. You have to look at them for what they are and realize that the world isn't going to stop because rates are going up. I think you have to adapt to the environment. It's always a good idea taking a conservative approach, especially for you folks who are working on joint ventures. Neil has investors that he's getting to put money in on various deals. He and Rachel have their own various interests, and you never really get hurt, especially when you're using other people's money, if you say to them, okay, we're taking a really conservative approach to this investment. We want to make sure that, this is what it is right now, but can we afford a few bumps? And that's why we're setting it up like this. I guarantee you that kind of approach, all that will do is get you more people who think, great. I don't want to do the work. And I really want somebody who's watching out for my interests where I'm confident that they are taking the kind of approach that will protect my very valuable money. And I don't have to worry about it as much. So, Sean, what about you on your end here in Alberta? Do you think that rising rates maybe give some of our creative folks a bit more room to do things? How does that look for you?
That's a good question. I guess if it's tougher to sell your property because of rates have gone up and there's not as many buyers out there, that's would open the door a little bit for some creative strategies that people may need to get out of a mortgage, or maybe they got one of those killer 1.5% fixed here, a couple of years ago, and comes up for renewal, and surprise, it's not 1.5 now, it's 5.5. So, can you afford to pay that extra 4% interest, or do you have to figure out a way to refinance and stretch out your amortization? So that could open the door to some creative strategies, AFS or something like that. So there's something I was going to mention with Neil's comments, and it's gone in one ear and out the other. So,
well, think about that. Think about that. I'll just ask you another question. I know one part of your brain will be working on that lost question, but here's another question. All right. So to your point about one of those sweet 1.5% mortgages. So if an investor runs across a property where a seller has that kind of a mortgage with, say, 2.5 years to run on it, and they want to assume that mortgage, let's say they're an investor with lots of money, lots of qualification room, and they actually could apply to the lender, or they actually, could go to a lender and get their own mortgaging. But if they want to try and assume one of those sweet low rate mortgages that still has some time to run, what the bank will make them qualify to assume, but are the rules, do they have to qualify for that mortgage as it is written at 1.5%? And that'll run for another 2.5 years, or is the bank going to make them qualify based on rates, the rates that would apply if they were getting to a new mortgage rather than an assumption of a mortgage?
It's been so long that any bank that I've talked to is even allowed to assume a mortgage. There's a lot of the commitments come back, and there's clauses in there that this mortgage is not assumable. I do have a client that she couldn't buy her house for a number of reasons, waiting for an inheritance, and was waiting for her house to sell. So she had about $400,000 or $500,000 that she was waiting for, but she really wanted to buy this house. So she got her sister and I guess brother-in-law to buy the house. They were great clients, 900 Beacon for him, and so they bought it, and she lived in it, and they got a good variable rate, true variable rate mortgage from TD, and which is better than what we can get today. So I said, the thing to do is to have talk to your sister and see if you can go to TD Bank and find out a way if you can assume this, pay some of it down or whatever. That's the best option for you to sort that out ahead of time. So I had the same thing today with someone who wanted to assume a mortgage, and I said, you gotta kind of work it with the bank and the seller, because there's also repercussions to the seller of the property. They don't get home scot-free off that mortgage. There's still some liability in the background, and I don't know, Barry can probably talk more to that. But if you let someone take over your mortgage, unless things have changed, I think you're still on the hook as the original mortgagor, are you not, Barry?
Well, the rules are different here in Alberta, Sean, than in the rest of Canada. So across the country, if somebody gets an insured mortgage under the National Housing Act, a CMHC mortgage, anybody who gets one of those mortgages is always responsible for the full mortgage debt, whether they own the property or whether they let someone else assume and take over their mortgage. And it's the same across the rest of the country if they get a conventional mortgage where they put 20% or more down. They're still always responsible for the mortgage, except here in Alberta. And in Alberta, we essentially have non-recourse conventional mortgages. So if somebody put down their 20% and life went bad and the bank had to foreclose and they sold the property, didn't get enough to pay the mortgage, only in Alberta, the bank can only take the property and they can't go after the people on their personal covenant to try and collect what they call the deficiency. So they can't garnish either wages or sell their car. And that would be so here in Alberta if somebody assumed a mortgage as well.
We have some questions.
And on that note, Donna says we have a few questions. I mean, I just get yakking away here. Let's look at some questions. Suzanne says, what about commercial mortgages? What rate would you stress test at? 9%? I don't know the answer to that. Sean, do you know that one?
I would not think you'd do 9%. I mean, commercial mortgages are a little more expensive than regular residential, unless you can get into CMHC and get one of their mortgages. And, commercial mortgages tend to have longer terms and stuff like that too. So, you might get my multifamily that I'm involved in, we got a 10-year mortgage when we got it. So, you probably have some ups and downs throughout that 10 years, but if you can predict mortgage rates in 10 years, then you're better than me at forecasting. Yeah. So I wouldn't think you'd use that. You'd use something more in the normal line of 5 or 6%, but don't hold me to it in 5 years. So.
What about you, Neil? I mean, you're not on the commercial side of things in your business, so that may not ever touch what you do.
So yeah, you're right. We don't really deal with commercial in terms of the rent-to-own side, but we are actually, as a personal venture, we are looking at multifamily ourselves. And I will be honest, being conservative, I'm probably stress testing around 7 to 8%. Because again, I need to feel comfortable and know that at night when I'm going to sleep, I know that, the rents I have, even if there are some vacancies and I'm, maybe burying something, I have got the reserve fund, number one, but I've got the cash coming in to cover, right? So if I run it too low, probably I'm just, even if it works for today, to Sean's point, I'm not going to hold anyone to it. But at the same point, I want to make sure that I feel comfortable with the numbers that I'm running. So I would probably look at 7 to 8% for me and our business, but it's a personal thing, I think.
Yeah, and folks, the other thing is I think all of the conversation and the government regulation and imposition of stress tests is far more aimed at the extremely busy, volatile residential market, and so I think that. Commercial mortgages have a lot more flexibility, and I believe they're less regulated than the residential side. There's, if you're thinking about a commercial mortgage, this is one where you've got to sit down for sure with the lender or a commercial mortgage broker and talk to them about their lineup of lenders and what they have on the stress test, because I think it's a bit more one-off than it is on the residential side. Next question, Neil, in addition to raising your qualification rates, are you lowering your annual appreciation on the properties as well? There's a good question.
Yeah, so as of today, I have not lowered the appreciation rates. I'm, again, being conservative. I'm not using 6 or 7% to begin with. I'm using 4 to 5%. I'm actually below 5%, and I have been for the full 12 years. So I'm not at a point yet where we're ready to adjust. I read an article today that talked about, and it's a ludicrous article, that talks about how prices in Ontario are dropping. The reality is we're seeing fewer offers, which means that we're not seeing massive price increases when people buy these homes, right? They're not offering something stupid, which is way beyond what they should be offering for a property just to get it. So I think we're not seeing prices, in my opinion anyway, we're not seeing prices drop, but we're not seeing them go up, exponentially either, right? We're actually able to make offers on properties and, offer 10, 15,000 below list. We're all actually able to get maybe a condition or two in there in some cases. We're still seeing, multiple offers. Like last night we went to offer in a small town outside of London, Ontario. Very small town, 3 offers. We were the highest offer, but they took one with no conditions. So they left 25,000 on the table just to make sure that they didn't have to go through a home inspection. To me, that's a red flag. You know, people are looking for multiple offers to get the most money that they possibly can. And in this situation, they didn't want more money; they wanted no conditions. Yeah. So it's not even, in my opinion, about the money or the dollars coming down on a property. It's more about the fact that we're not seeing as many offers, which is keeping the prices that we're buying homes at a more realistic amount, right? So, you know, I've always felt that the Canadian average is kind of where I want it to be. And I think it's 3.5 to 4.5% and around there over the last 10 years, 15 years. So we've been using those kind of numbers. And again, I feel very blessed that over 12 years, I haven't had one property at the end of the rent-own term not appraised for the value that we've set. So it's been very lucky. But again, I think it's got a lot to do with just being very conservative.
Well, being conservative and lucky, I mean, that's a good combination. You're lucky to be in, I guess, the Ontario market where it's been so supportive of that. But hey, that's where you are, and never, sometimes it's better to be lucky than be good, but it's probably a combination of both. Donna, is that all our questions for the moment? I think so. I think that's all we've got for now. Anyway, Donna will pop up more over the next little while. Now, when we're talking about rates, this isn't really a comment on whether whether rising rates are a benefit or a detriment to investors, but people choose between variable or adjustable or fixed. I mean, I guess we'll use variable because everybody thinks variable means adjustable. So let's not get into that too much. I know you explained it, Sean, but what do you think the stats are, Sean, here? And then we'll ask Neil, what are the statistics for people who take a fixed rate mortgage thinking they picked 5-year fixed and there's no reason to think they won't be in there for the full 5 years. But Sean, most folks are wrong about that. And how wrong are they percentage wise of the people who, if there's 100 people pick a 5-year fixed, how many of them are looking to pay it out before that 5 years is up?
Well, the numbers that I've heard thrown around from different mortgage brokers like Dustin Woodhouse, he's a stats freak. 65% of the people will break their mortgage in an average of 3 to 3.5 years. So that's, 2/3 of people will get out of their mortgage before it's due. So you're thinking about the penalties and the other things, you can speculate all you want about, where the rate's going to go. If you think variable is going to go crazy and rates are going to go up, and you think I'm only going to pay a 3 months of interest on my fixed rate mortgage because rates today are 4% and they're going to be 7% in 3 years, and that'll be high enough that I won't pay a penalty. Or rates going to go down and I'm paying 4% today and they might be 3% in 3 years, and my penalty could be, thousands or tens of thousands of dollars depending on the value of the mortgage and how much time is left there. So just that's, a sidebar to the different types of mortgage you take and the rates, is that you really have to understand if you are getting out of your mortgage, or you think you might get out of your mortgage, let's look at the penalty side of things. And, big banks tend to have a little more onerous penalties than some of the monolines. And, even on variable rate, there's some lenders have different ways they calculate it. They calculate it on the prime rate versus what we call a contract rate, which would be, say, prime minus. If you had prime minus 1%, they would use that rate versus the prime rate to calculate their penalties. And some have a reinvestment fee. So, there's issues about you might be moving. Fixed rate would not be my choice for clients. And
No.
I know there was you're talking about, what do you tell the clients about variable versus fixed? I just tell them all the pros and cons, and it's really up to them to flip a coin and, go with what, mom and dad say, oh, you got to lock in your mortgage, and because you don't want to risk variable rates and
Yeah.
because that's the way they always did it. So
Sure enough. Neil, what about you? Do you see that same sort of stat? Two-thirds of people who pick a 5-year fixed will get out in 3 to 3.5 years.
Well, it's a great question, and it's one that it's going to be a bit more difficult for me to answer because in rent to owns we don't really have 5-year deals, so they're usually 2, 3, or 4. People take variables so that they can exit those.
Yeah.
With the amount of the equity, I should say, the equity that's been sitting in a lot of these homes, we have tenant buyers that are buying out after 2 years instead of the third year.
Yeah.
They want to access that equity, so they're actually paying full price, but we're breaking the mortgage, and the mortgage penalty actually is passed on to the tenant buyer. So for an investor in a rent to own, they're not seeing the penalty. It doesn't impact them. They're happy to sell at full price after 2 years or 3 years. It doesn't matter. Penalties covered by the tenant buyer. But I think if you're looking at residential, people are actually buying and living in their homes rather than investors. I think it's probably much higher. There are more people staying past 5 years because here in Ontario, where are you going to go?
Yeah.
Right? Like if I sell my house at 1.1 million, for me to buy something similar, I'm going to pay 1.1 million or I'm going to pay 1.4 million, whatever. And these are stupid numbers. Like these numbers make no sense to me when I think about them. You know, they're very distracting because, you know, we're not used to them, right? You used to think of $1 million home was an estate or a mansion up on 20 acres or something like that. Now it's a subdivision home in Ontario. So a lot of people that I know, and I've talked to a lot of people who live around me, and their questions are always the same. If I sell, where do I go? Well, you go an hour north. That's the only way you're going to make any money on the property you're selling and buy something that's a little bit cheaper. So I think that you're seeing more people stay past the 5 years. So again, fixed versus variable, it's a personal decision, right? What can you sleep well at night with? Some just can't handle a variable. They're just worried about what that next thing looks like, whatever's going to happen next. What's it going to look like? Others, they're fine with variable. They know that it's putting a little bit more money in their pocket if they keep that variable versus going to fixed. So it really just depends. And, you know, I would never guide anybody or advise anybody. I would, like Sean said, here are the pros, here are the cons to both.
Yeah.
Make the decision that makes sense for you. That's really how you should play it out.
Yeah, you know, that is, I think, solid middle of the road advice that really fits the situation. And I had a client last week who came in and signed up her variable rate mortgage 2 days before closing. I got the frantic email later that evening that she couldn't stand it. She couldn't sleep, and she called her broker and got it switched to a fixed, and came back and signed. And you know, there's the cat. Get out of here, cat. Come on. So people do, you know, obsess, and, you know, it's stressful for them. They just can't stand the uncertainty of having variable. And I've had 2 or 3 people this month who thought they had a variable mortgage, had a fixed mortgage, and are paying $13,000, $15,000, and $17,500 worth of payout penalties that they have to pay themselves, as opposed to what Neil said in the rent to own side of things. The tenant buyer pays the investors payout penalties, and they probably don't mind a payout penalty of that magnitude or larger because the mortgages are larger. If they've had a $100,000 or $200,000 equity bump that they want to access, you know, paying that penalty is that's fine with them. Yeah. So it's different, definitely different situations for different parts of the creative market. I see there's one more question here aimed at me. I've read other rent-to-own contracts that had a clause where if the appraisal comes out lower at the end of the rent-to-own term, the difference between the agreed-upon sale price and actual sale price be split 50-50. Barry, what are your thoughts on clauses like this? Yes, I have seen rent-to-own contracts like that, and I don't mind that kind of a clause. I wonder, I don't mind that actual clause because it has people sharing the up and down of things. If you get in Alberta, we had trouble with conventional rent to own for quite a while because we would put an appreciation rate in the contract, and then because of the Alberta economy, you'd get to the end of the 2, 3, 4 year rent to own term, and the appraisal would come out, and the value is maybe equal to or usually less than what the contract said it should be. So that kind of a clause has its benefit for where markets are fluctuating, because if you don't have that kind of a clause and values don't line up, then you have to have concentrated, serious negotiations, or what are we going to do when the contract says you have to pay, using Alberta numbers, $450, but the appraisal says it's only worth $400. So that clause can be a very useful kind of clause, and I don't mind seeing those talked about and put in contracts where it's appropriate. All right.
Typically, rent-to-own contracts, you have to have a firm price. So I don't know how you'd approach that with the bank, or you would.
Well, I've always thought it should be a fixed or determinable price, but at the end you have to come up with a price. So yeah, when the market isn't supporting things, it is more difficult for sure.
Yeah.
All right, let's see. Any more questions? Not at the moment. All right, laddies. Well, I think we've given this a pretty good going over in terms of what the rising rate market means to people, both in the kind of focused area that Neil and Oliver have with their rent-to-own business.
Neil and Oliver?
Neil and Rachel Oliver.
I won't tell her, Barry. Don't worry.
Or he called her Ollie.
I will not tell her. You're okay.
All right. I'm sure she never looks at these. She's not really much of a media person. She doesn't know her way around that very well. She'd never look and see me saying that.
We're saying that now, but she's probably watching live.
She's probably watching. She could give me help.
Just to hear you say that.
So, it's kind of different in the specialized end that Neil and Rachel have versus Sean's more broader servicing of the creative market. But I think we've heard some interesting conversations. So let's maybe go to some finishing comments. Sean, let's talk to you for any finishing comments you have on the rising rate environment and what that means, positive or negative, for our creative real estate investors. Finishing comments from Sean. Well,
like I said earlier, if it slows down, it becomes more of a buyer's market, which it's not there yet. A buyer's market means there's more opportunity for creative real estate deals to be done. So, when it's a hot market and things are flying off the shelf, no one wants to do an agreement for sale or anything like that, or vendor takebacks, or not, because they can sell it for top dollar and have unconditional offers come rolling in the door. So, I don't know. There's much more to say about what's going to happen with the rates. Obviously you need to talk to your broker and look at all the different options, and your broker needs to ask you the right kind of questions to know what your circumstances are. And I've had a few clients where they just said to me, I'm not going variable, so let's not even talk about that. Just find me the best rate.
Okay.
Way to go. So, there's no amount of convincing him. And generally I find them to be more in that, 30, 35 age range, where probably mom and dad are still around to give them some advice, or however good it is or where it came from. But so that's
all right.
That's enough for me for tonight. So
okay, Sean. Well, that's always useful to hear that. Now, folks, that Sean is a mortgage broker here in Alberta. He helps folks who are doing regular purchases just for their own, to move into. He helps all kinds of investors, including creative investors. Neil, on the other hand, along with Rachel, run Clover Properties, their rent-to-own business. So, Neil, I don't think you're helping people with mortgage or mortgage questions, because that's not part of your rent-to-own business. You do your mortgage agent work for your own internal clients, and so you're not helping other people, I believe. Is that correct?
You are correct. But I do have a few tips, right? Because I do think that rent to own is one of those strategies. And again, we've been doing it for so long that I've seen every market, or at least most markets. I guess I haven't seen the most extreme 17, 18%. I hope to God I never see that, but I know it did exist. But as long as you're qualifying the people, and we are finding that there are amazing, amazing clients that can't get bank mortgages right now. They have great income. They have a great down payment. They've just got something holding them back on their credit, or they have a little bit of debt because they decided to buy very expensive cars, right? And they're not ready to get a mortgage, but they are looking at getting into home ownership because they don't want to pay $2,500, $3,000, $3,500 a month in rent. So we are finding that these are great candidates for the higher interest rates. They're even great for the lower interest rates, but they work really well because their income supports the monthly payments, even 4, 5, 6%. So as long as you're qualifying them at that percent, it doesn't matter what the investor can get as long as it's below what they're being qualified at. Rent to own can always work, right? And even from the perspective of, well, I think at the end, I think 2, 3, 4 years from now, I think Sean did mention that, and I think the same. I don't think interest rates are going to stay this high for a long period of time. I do think we're going to see somewhere along the line, they're going to recess back a little bit, but how much, we don't know. When that's going to happen, we don't know. But a lot of my tenant buyers are exiting or will be exiting at probably less than where we're at today, right? At least that's the hope. Fingers are crossed. I can't make any guarantees, but we're definitely planning for that. But again, being conservative, I know that even if the interest rates stay the same, they're going to be able to qualify either way. So, it's really important. I think Sean mentioned it too. Talk to an expert. If it's a mortgage broker, talk to a mortgage broker. Find out what's going to make sense. Run your numbers conservatively. Stress test them for sure. And my last bit of advice is don't over leverage. Yeah. Right? You start refinancing your property at X amount of dollars, and all of a sudden interest rates increase, and now you don't cash flow anymore. Now you're negative, cash negative potentially, right? So it's just being very careful, being very conservative, and everybody should be just fine.
Those are pearls of wisdom. Well, Sean and Neil, thank you guys very much for coming on. I love these conversations where we get into the nitty-gritty of how mortgages and financing work from a couple of different perspectives, but guys that know their way around the money world. Thanks to Wayne in the background for running the show for us.
There's one quick question.
I don't see
one last question I saw there that Sudesh had.
Stress test has also changed with this rate change. So does that mean the stress test number goes up, or what does that mean?
It's still 5.25 today. So speculation, it may go up. So just on that side note, the rules for the stress test is you have to use a stress test at 5.25% or the contract rate, which is the rate the bank's going to give you, plus 2%. So if rates are 4.5 today, then we have to stress test them at 6.5%. If you're getting a variable rate mortgage and prime is 3.7, and you're doing, if it's an owner occupied, you're going to get at least half a point off that. So that's going to be 3.2, maybe down to 3. You add 2% to that, you're still at or under that 5.25%. So that's a popular strategy right now. Is people are applying for a variable rate mortgage, they can use the stress test rate. And then if they feel the need to lock in down the road, then they can lock into a fixed rate in the future, having already qualified now. Yeah. The caveat on that is, of course, if you have to sneak by to qualify using the stress test on a variable, can you really afford that fixed anyway? So it is one way to get around it.
One way to get around. All right, Sean. Well, thank you for those last important words. Those are important words about why you need to know your way around this business and the number side of it. So thanks again, Sean Impey.
Most important words are go Oilers go.
Yes. Hey, 6 o'clock. Whoa. All right, guys. Well, see you later. It's been fun. Bye.
Let's go.